Market efficiency, efficient market hypothesis, EMH. Core idea. The EMH posits that financial markets are efficient, meaning that asset prices fully reflect all available information. In such a market, it's impossible to consistently beat the market, i.e., achieve returns higher than what's justified by the risk taken, because any new information is immediately and fully incorporated into prices. Forms of EMH. Weak form efficiency. Prices reflect all past market data, e.g., historical prices, trading volumes. This implies that technical analysis, studying past price patterns, cannot consistently generate abnormal returns. Semi-strong form efficiency. Prices reflect all publicly available information, e.g., company financial statements, news announcements, economic data. This means neither technical nor fundamental analysis, studying a company's financial health and industry, can consistently lead to superior returns. Strong form efficiency. Prices reflect all information, both public and private, insider information. If this form held true, even insider trading wouldn't lead to abnormal profits. Most economists agree this form is unlikely to hold in reality due to regulations against insider trading. Proponents' argument. If markets are efficient, any deviations from true value are quickly arbitraged away by rational investors who seize opportunities to buy undervalued assets or sell overvalued ones. This constant activity ensures that prices generally reflect fundamental value. Fluctuations are primarily due to the arrival of new, unexpected information, which is, by definition, unpredictable. Implications of EMH. Passive investing, e.g., index funds, is often advocated as the most rational strategy, as actively trying to pick stocks or time the market is futile and costly. Resources are allocated efficiently because capital flows to its most productive uses. Behavioral economics. Core idea. Behavioral economics challenges the EMH's assumption of perfectly rational market participants. It argues that psychological factors, cognitive biases, and emotional influences systematically affect investor decision-making, leading to deviations from rational behavior and, consequently, from true value in market prices. Psychological factors at play. Heuristics and biases. Anchoring. Over-relying on the first piece of information encountered, an anchor when making decisions. Confirmation bias. Seeking out information that confirms existing beliefs and ignoring contradictory evidence. Availability heuristic. Overestimating the likelihood of events that are easily recalled, e.g., recent news, vivid stories. Representativeness heuristic. Judging the probability of an event based on how well it matches a stereotype or previous experience. Framing effect. Decisions are influenced by how information is presented, even if the underlying facts are the same. Emotions. Fear and greed. These powerful emotions can drive irrational exuberance, bubbles, or excessive panic, crashes, pushing prices far from fundamental value. Overconfidence. Investors tend to overestimate their own abilities and the accuracy of their information, leading to excessive trading and risk-taking. Loss aversion. The pain of a loss is felt more intensely than the pleasure of an equivalent gain, leading investors to hold on to losing investments too long or sell winning investments too early. Herd behavior, social proof. Investors often follow the actions of a larger group, even if those actions contradict their own information or judgment. This can lead to fads, bubbles, and panics. Mental accounting. People treat money differently depending on its source or intended use, leading to irrational spending or investment decisions. Behavioral economics critique of EMH. Behavioral economists point to market anomalies and historical events, like speculative bubbles such as the dot-com bubble or the 2008 housing crisis, as evidence that markets are not always rational and can deviate significantly from true value for extended periods. They argue that these psychological biases create inefficiencies that can be exploited, at least in theory, by informed investors. Implications of behavioral economics. It provides explanations for irrational market behavior and price volatility. It suggests that active management can potentially generate abnormal returns by exploiting these inefficiencies, though this is still challenging. It highlights the importance of understanding human psychology for investors and policymakers. Conclusion: do markets always reflect true value? The prevailing view among most financial professionals and academics today is that markets are generally efficient, but not perfectly so. In the long run, and for highly liquid, well-researched assets, market prices tend to converge towards fundamental value. Arbitrageurs and rational investors will eventually correct mispricings. However, in the short term, and especially during periods of high uncertainty or market sentiment shifts, psychological factors can and do lead to significant deviations from true value. These deviations can create opportunities for those who are able to identify and act on them, but also considerable risks. The debate between EHM and behavioral economics is not about which theory is right or wrong, but rather about the degree to which markets are efficient and the extent of psychological influence. Behavioral economics has enriched our understanding of financial markets by acknowledging the human element, providing a more nuanced and realistic perspective on how prices are formed.